Good morning, everyone. It's the 30th. That's wild. March is almost over. We have done some really good work in the last week and had so many floor reports. We have a couple on third reading today, but we also have the yield bill on the floor today. Thanks, Scott, for carrying that one for us. And then, there are lots of pieces of the budget that have obvious nexus to our work. So I'd appreciate everyone's support on the floor if anything comes up regarding the budget that's relevant to us. So we are going to talk about S45, which is a fairly discrete bill that the Senate has kindly sent over to us. Oh, we're not. I'm totally on the wrong bill. Sorry, we're going to talk about S45, which is the pass-through bill. I was thinking about wood heat boilers, which we were talking about a second ago. Sorry. So the pass-through entity income tax and credit is sort of a big topic from the viewpoint of sort of good tax policy. And there are a lot of questions and sort of interesting tax philosophy buried in it. That we're going to get through, but it's also sort of an opportunity to talk about how wealth is held in Vermont and how we sort of tax that wealth. We've talked a lot about payroll taxes. A lot of wealth in Vermont is not from people who have payroll. It's usually other forms of income. And so this is sort of one opportunity to talk about that a little bit deeper. So we're going to start that conversation today, but definitely won't finish it today. And then at 10:30, we're going to start a conversation around financing of emergency services. There are a few different buckets there that we're sort of prepping for. One is the Gov Ops Committee on both sides have done a lot of work on dispatch and is going to continue doing work on dispatch. There are a lot of questions around municipalities right now are paying in very, very different ways for dispatch. And so if we wind up with a system that's more consistent around the state, we're going to need to find a new financing mechanism for it. Likely not spending any more money or less money, just maybe spending the money slightly differently. And so that's something that we're going to explore. There's also E911, which is paid out of a fund that has been rapidly depleting because it's connected to phone costs, which people use differently. And then there's also a few other sort of emergency services questions around provider taxes for EMS and if those are sort of a useful mechanism. And so it's going to be I'm hoping it's not as chaotic a conversation as I am sort of anticipating it would be, but this is going to be sort of our first pass at financing of emergency services that are right now all funded in very different ways to see if maybe it makes sense for us to consider those issues in concert somehow. So don't expect any resolution at our 10:30 agenda item. And then at 11:15, we'll be talking about wood boilers, which is slightly more discreet. And with that, all of those public service announcements. Abby, hi. Will you take us through this bill that came over?
Sure. Thank you. So for the record, Abby Shepherd, Office of Legislative Counsel. There are a couple of different documents under my name. I do have a presentation prepared that I can go through fairly quickly, but I think it's important to have some background on this because once we dive into the details, you really need to know what the overarching structure is. So the first, I can share my screen if you'd like.
Thank you.
The first document under my name is the presentation. So I will. Okay, that's big enough, right? Okay, so just diving right into it. So we're talking about personal income tax, and really we're talking about federal personal income tax. It does not directly affect Vermont tax liability currently, but I do need to lay out how federal income tax works with regards to this deduction. So the first step when you're looking at how this all flows through is remembering what taxable income means. And that's defined under federal, the Internal Revenue Code. So first you start with gross income, which is all income from whatever source derived. Then you have adjusted gross income, and then you have taxable income. So that's gross income minus either the standard deduction or itemized deduction. So I'm skipping over the AGI because it's not really relevant to this deduction. So one itemized deduction is the whole purpose of this presentation, the state and local tax deduction. So under Internal Revenue Code section 164, you have a list of all the different types of state and local, and actually you do have foreign property taxes here that are deductible. So there's a whole list, and at the bottom, there are some others that I didn't include here because these are the main ones. At the bottom, you'll see you are also allowed under federal law to deduct general sales taxes, but that's in lieu of income taxes. So most people are deducting income taxes. It's generally a higher tax burden. So throughout this presentation, and as I talk about S45, I'm going to talk about the SALT deduction, and I imagine you've heard about that in different tax policy discussions. So that's what the SALT deduction means, state and local tax. So with the Tax Cuts and Jobs Act in the very end of 2017, starting in 2018 in that tax year, special rules were added affecting this itemized deduction. So again, just to reiterate, it's not the standard deduction, it's only for taxpayers who itemize. So for tax years 2018 through 25, foreign taxes were disallowed from the deduction, and a cap was applied to the amount of taxes that can be deducted in any tax year. Most people talk about the $10,000 deduction. That's for married filing jointly. There's also sort of a limited cap that's for married filing separately, and that's $5,000. Again, because the foreign taxes are not allowed to be deducted, it applies to property taxes, personal property taxes, income taxes, or sales tax. You can't take sales tax and income tax. So I've noted here, and I apologize, just before coming over here, I realized there have been other bills. So I do have a list, and I can provide that to the committee after. I've noted the 2021 Build Back Better bill did propose capping it at a higher amount. That did not pass. Just this, in this year, 2023, there are 3 different acts in the House of the US Congress right now. One proposes to repeal the cap, and then the other 2 propose to increase it either to $100,000 or double it. So there are different proposals out there. None of them appear to be moving at this time. There's also an act or a bill that's being proposed to make this cap and all of the Tax Cuts and Jobs Act provisions permanent. None of these bills appear to be moving, but just so you're aware, there are proposals federally to change this. So just pause there. I will talk a little bit about what other states have done in response to this and give you a bit more background, but I also just wanted to walk you through how this impacts Vermont. Pause there. Okay. So first, I'm noting that Vermont's taxable income definition was amended in response to the Tax Cuts and Jobs Act. That was that huge overhaul that added standard deductions, personal exemption, completely decoupled from itemized deductions. So Vermont only has federal itemized deductions if it enacts them into statute, which means that this SALT deduction does not directly impact Vermont tax liability. It does impact taxpayers, of course, because they are affected at the federal level. And then I didn't add this here because I think it maybe is too complicated, but just to remind the committee, the year prior, you had shifted to AGI as the starting point. So that's another way to decouple from these sort of changes. So Vermont is fairly insulated from these changes right now on the way statute is drafted. Okay. So this gets into more of the national context and how other states have reacted to the cap. So again, at this point, that was enacted it was enacted 5 years ago. Over that time, many states have responded to it. This tends to have a higher impact on states that have a higher tax burden because taxpayers cannot deduct the full amount of state or local taxes. So states reacted by passing legislation that either created a mandatory, in that case, there's only one state, the very first state that created one of these tax structures, that's Connecticut. All of the other states that have created these have made elective entity level income taxes on pass-through entities when they are doing business or have income derived from or connected with sources in the state. And I included all of that language just to make it clear that this is where the state has jurisdiction to tax that income. And as a reminder, I know we did sort of a deep dive into pass-through entity taxation. Pass-through generally is not taxed at the entity level. There are some exceptions to that. But just the general rule, the sort of purpose of pass-through is that the individual members are paying on the income on their personal income tax form, as opposed to a C corporation where they're paying both at the entity level, and then the distributions are paid, income tax is paid by shareholders. So the way that these salt cap workarounds have been enacted, and if you note later that this particular structure has been approved by the IRS in a notice. There are still no regulations from the federal government on this. So it's based on a notice, but that has been enough for states to take action. So the state tax is paid by the pass-through. That can then be deducted from the pass-through's income at the federal level because the SALT deduction cap does not apply to businesses. It was clear that it didn't apply to C corporations and also to pass-throughs. That's what the notice clarified, is that an S corp or partnership is able to fully deduct any state and local taxes paid. So states are creating new tax structures that apply to the pass-through. The pass-through deducts it, gets the full amount. That reduced federal tax liability is passed on to the members. The pass-through then also passes on that new state tax to its, not new, but once it's created, it's new to its individual members, who then, under this structure, are able to claim a credit for that amount of tax paid. It's a credit or a deduction or exclusion. The different examples I've looked at have all been credits, and that is what is in the bill that I'll walk you through shortly. So again, this is the notice. It was at the end of 2020. The Treasury Department and the IRS said this is okay. There were some other types of workarounds that were rejected by the IRS, in particular creating a charitable contribution to the government that would then be deductible. Said that is not charitable, that does not fly. So those were disallowed, and then states said, okay, we'll take this approach instead. They tried. There were some others. That was the most common. And then litigation ensued, and the IRS issued regulations saying, nope, that does not work. This has actually been updated since I updated this slide. Since S45 passed out of the Senate, now 30 states and the city of New York have enacted salt cap workarounds.
So the city of New York has one, but the state of New York does not?
I believe the state does.
Okay.
But I can check that. I think I have a map. I do. Yes.
Okay.
This year.
So both.
Yes. Okay. I'm not an attorney admitted in New York, so I can't really speak to that. But I could look into that if you'd like.
No, it's not actually, I mean, we don't have enough local taxes that would be worth even understanding better. So I was just curious.
Massachusetts had one also?
Should I go to the next page?
Recall that?
Yes.
Yeah.
There it is.
Okay, yeah.
So this is from some CPAs, and they've provided a lot of detail in the key here. So it has proposed pass-through entity taxes in sort of orangish yellow. Vermont's included there. All the blue are those states that have enacted one. Some with later effective dates, and I think it's Colorado, where somewhere had a retroactive effective date. Not seeing it on the.
And the gray states are sort of, it's an irrelevant issue for them because their taxes aren't structured, so it makes sense. Okay.
That's right. No owner level personal income tax, like Florida, no personal income tax.
Okay.
So
And then
a few that either it's irrelevant or don't already have it or aren't considering it.
right. And the only 7 states, correct, that have not yet proposed or enacted a personal income tax, pass-through entity tax structure. Great, make sure I didn't miss anything. So as I pointed out, Connecticut was the first state to adopt one, and it's the only state that's made it mandatory since the IRS guidance came out. The states felt more comfortable making it an elective. And my understanding from reading some different tax policy and tax planning advice, and I'd be happy to share that with the committee, there's sort of this, be careful of each member won't in any way be penalized by electing to do this. That's why it's made elective and not mandatory. But I think the initial impetus for making it mandatory was to be absolutely sure it could be enacted or could be deducted as a state tax because of that mandatory, because when you have a tax, it needs to be mandatory and fall on everyone. That said, with the IRS blessing, it's clear that elective taxes are still allowed to be deducted. Might be the last slide on this. It is. Okay, so I'd be happy to walk you through the bill unless you have other questions about the general legal background and what other states have done. And I'd be happy to follow up on any particular state if you have more questions.
I think we're all gonna have questions as we go.
Actually,
Oh, yes.
is there much variation in the percentage and the actual amount of the state tax?
That's a
USD tax?
Great
for
question.
states?
So I'm not sure about the actual rates, how much variation. The S45 is based on a particular rate in Vermont law, which I can look at other states to compare how they've set their rates. So it says to actually look at the language, it chooses a bracket and a rate to apply. And then you have more variation in how much the credit or exemption is given, because that's where you see either a positive or negative impact for state revenues. So when you're applying the tax and then giving an offsetting credit, that is not a full credit of the total amount of tax paid. So that's where you see the most variation.
I think ours was 0.8, if I remember.
In S45, it's 90% of the tax paid.
0.9, okay.
Yes. So that, and I would defer to Ted to tell you more about what that looks like in terms of numbers. Because that's the primary sort of policy discussion I've heard about that is what's the revenue impact? Yeah.
A little off topic, but related. Someday when you have nothing better to do, it'd be nice to have a little presentation on what our neighboring states do and don't tax, like New Hampshire. I mean, it's not pertinent for right now, but periodically it comes up. And people say things that are both true and false. And it's not, I don't mean to interrupt your 19 things to do, but it's just really nice to know about that.
I agree. I think it would be hard to do it across the entire spectrum of taxes, but it might be something that we could think about doing in like specific tax areas that we're taking on. For instance,
Personal taxes and
Yes.
the most prominent business tax.
that's like a good thing for a new biennium at the beginning or something. I don't know.
Yes, that would be a really interesting summer project.
Well, I was thinking maybe we'd hear in January if you got it wrapped up or something like that.
I think trying to do all taxes. That said, I know I was just looking at the fiscal facts from JFO and there are some comparisons of like overall tax burden. I think it's challenging even slicing it by state because Vermont has so few local taxes.
Best request is not to make it so complicated. You know, just the things that we mostly hear about. Oh, you're in New Hampshire.
Yeah.
Thank you.
Right. Did. I'm just gonna pull up the next. Would you prefer to look at the section by section or the language of the bill of S45?
I think the section by section is fine for now. We're, gonna take our time on this.
Great.
So we just want to understand the structure better before we hear from Ted.
Great. I will share the section by section. Okay. So I realized I actually just asked for a little feedback. I've always provided a notes column in my section by sections, but I'm realizing that's because I assume you would print it out. Do you want me to stop doing that for yours?
Oh, I actually really
So
like that word.
Okay, I'll leave that there. Like, oh, it's taking up so much space.
No, it's fine.
Okay.
And I do often print them out.
Okay, great. Yes.
Yeah.
Now that I'm here in person, I'm used to using so much paper. So the first section of S45, which is nowhere in the title does it say the SALT deduction. It is an act relating to an elective pass-through entity income tax and credit. So it's a SALT deduction cap workaround bill. And the findings lay out a lot of the background that I just went through in that presentation. It states the purpose and a lot of the legal background. So it talks about the Federal Tax Cuts and Jobs Act creating this cap. And it talks about the number of states at the time. It was 28 or 29 states. So as of January 1st of this year, 29 states had responded by creating SALT deduction cap workarounds. And then it has a short summary of those. So it's really a statement of fact, much of what was just in that presentation. That's section 1. Section 2, I won't spend much more time on that. Section 2 is the bulk of the bill. So this is where you have a whole new subchapter. I'm just going to hide that to give more space on the screen. This creates a whole new subchapter within the income tax chapter in Title 32. So it's creating a new tax and a new offsetting credit. And then it also amends an existing section within Title 32 that's in the next section of the bill. So there are a few different definitions. I've only pulled out a couple that I think are really important for the committee, but I'd be happy to walk you through the others. The first is distributive proceeds. So that's what this tax would apply to. Net income, dividends, royalties, interest, rents, guaranteed payments, and gains. It defines member, which is important to note in this bill. It's only a member of a limited liability company, a partner, or a shareholder of an S corporation. It is limited to natural persons, so no legal entities can be a member of a pass-through. And then it again defines pass-through entity as a limited liability company, a partnership, or an S corporation. So it does not include C corporations. The other two definitions are that what the pass-through entity, business income tax, that's what this tax is, and then the share of distributive proceeds, which is the portion that the member is receiving. Okay. The next new section of statute that's created in Title 32 is Section 5921B. So this is where the new tax is created and it's clear that it's elective. So the tax is on the pass-through's distributive proceeds. And again, these are only those derived from or connected with Vermont sources. That gets at the nexus and Vermont's jurisdiction to tax this income. And this is where I apologize, I didn't remember which exact rate was being applied here, but it's the second highest marginal individual income tax rate, which is 7.6%.
Was there a reason, Abby, that you could share with us as to why the second highest was chosen?
It's
just a policy decision.
My understanding is that in other states it's set at a certain rate, but I think that's more of the being able to ensure that the revenues are neutral, neutral or positive, so that you know how much it wouldn't be a variation. Again, it's an entity level tax, so you could make it more complex by having
or
brackets.
Just the highest rate. The
Correct.
point that it's second highest just caught my eye. Okay.
I don't have particular policy insight into that, but it's definitely a policy decision which rate is applied.
Yeah, thanks.
Who is the sponsor in the Senate?
This was Senator Chittenden, let me just pull, and Senators Baruth, Brock, Clarkson, and Ram Hinsdale, sorry.
Okay.
Welcome. So again, only pass-throughs that have individual members, natural persons, no C corporations are eligible to make the election.
Say that again, please.
Sorry, so again, this was discussed last session. A lot of this bill that you see before you was, I don't want to say recycled, but a lot of these questions were discussed in the Senate last session. And this was one in particular that was highlighted as a concern for the tax department, but also in terms of making it simpler, was to ensure that only individual natural persons, so humans, can be members of these pass-through, not other entities like C corporations, which are legal entities.
Or trusts.
True, that's correct. So it's limited to individuals.
So this has to be circumstances where in the LLC doesn't keep the money. It passes through to his members as salary or as something.
As proceeds, correct, as distributions.
Okay. And then the individual who receives it pays the tax.
So this would be that's current law. Personal income tax is paid by the member rather than the entity paying. So this would create an entity level tax. The entity would pay it, but that actual cost is passed on to the individuals, who then are able to take a credit on their own personal income tax for how much they paid. It's called their pro rata share of the entity tax. This creates it in Vermont. So there will be a benefit both in Vermont. They would still have a small share of tax that they're paying because the credit's only 90% of the entity tax paid. But the federal level is where the biggest benefit is because the entity is then able to deduct all of that pass-through entity tax federally. So that's reducing the individual member's federal tax liability.
Okay.
Great, thank you. Great questions, because I'm not necessarily hitting every single one of these points as I walk through. Thank you. So these are the different criteria that the pass-through must meet to be able to claim this or claim to elect to be taxed under this structure. So at least one member of the pass-through has to be liable for income tax in Vermont. The election is made by consent either of every member of the entity or by an authorized officer or manager or someone with that sort of authority to bind the entity to pay the tax. Also of note, non-resident members of pass-through whose only Vermont income is from the pass-through, subject to this new tax, they're not liable for Vermont income tax or required to file a Vermont return. So if they don't have any Vermont income other than paying this tax, they aren't then required to go file a Vermont income tax return.
The entity, under this new system, the entity is taxed an entity tax of 70.6, and that comes off their gross income.
They would then be able to claim that as an itemized deduction or as a deduction federally, and it would reduce their taxable incomes federally.
What about property taxes, local property taxes?
Also.
They would also be able to deduct
Correct, because and they are not subject to the $10,000 cap, only individuals.
Okay.
And they'd also be paying, if, say, they were in the highest tax bracket, they could be choosing to take a slightly lower tax bracket on the pass-through. So they'd be taxed on the pass-through income rather than on their income taxes,
No, they would still be,
paying their income taxes on the income as it comes through. Second.
yes, and their income that comes through,
Would be taxed at whatever bracket is appropriate.
yes.
The
And it
there
would
you're
be-
referring to as
maybe-
members of the entity?
Oh, sorry, I assumed you meant members.
Not members.
Okay, okay.
Can you explain that non-resident members of, I mean,
Yep. I'm just gonna pull up the language.
they might have income, but they would not be liable for income tax?
No, if they're only, let me read you, maybe I should pull it. So a member of a pass-through entity shall not be liable for individual income tax and shall not be required to file a return if they are a non-resident of Vermont and their only Vermont income from the taxable year is derived from a pass-through entity that has paid this tax, this pass-through entity.
Because they've already paid it at the entity level.
Correct.
Understood.
And they have no other Vermont income that would be subjecting them to Vermont income tax. So it's sort of
I
separate.
need like a visual for
I-
this.
yes.
I think that really helps.
Are we about to get one?
I might have one.
We'll have something to.
We'll get closer. We're gonna get closer to visuals. So yes. We're gonna keep on talking this through until it becomes clear because it is quite complicated.
We do have a whiteboard.
We do. Back to you, Abby.
Great, so that is the section that creates the tax. Those are the ins and outs of.
Not even listening.
And again, it is elective, so it's binding for the year when the election is made, but the entity, let me just confirm. Yes, it has to be made each year. So it's not an ongoing automatic, Sun opt-out. It's the entity actually has to take action to say, yes, this year, this is what we want to do. And there are circumstances where, for example, non-resident members may not want to be subject to this tax in Vermont. So it's still elective. And the next new section of statute that's created is a refundable credit. So this is where this 90% I mentioned comes in. So it creates a refundable income tax credit for the individual members of the pass-through. When that pass-through is elected to pay this entity level tax, it's 90% of each individual member's pro rata share of the entity level tax that's been paid. And there is language I didn't include in the section by section, but just to make sure that you're aware of this, the credit is available after the application of all other credits allowed by law and claimed by the individual during the taxable year, and it is refundable. And I think I wrote non-refundable. My apologies. I think that's incorrect. Oh,
It says refundable. Where do you, is it
oh,
not?
I'm sorry. I skipped ahead. I'm looking at the, okay, no, that's fine. Looking at the wrong section by section. The next credit is non-refundable. Okay, so there are two credits. That's why I'm,
They pay taxes so that they can get a credit federally, and then we give them back their taxes so that they gain something from the Fed from avoiding federal taxes and didn't have any impact on the state level.
it's 90% of what they paid at the state level.
Thanks.
Cool.
The first credit is for this entity level tax paid. The next credit is in an existing section of statute. And this is the credit that's non-refundable. So that's in the section.
And I just want to clarify again, so this is this sort of workaround from federal taxes that we've created for people that we're sort of holding harmless at the state level so that they can get this workaround at the federal level is right now in a somewhat politically tenuous, precarious position. Is that, you talked about how there are multiple bills doing multiple different things. It's set to sunset at the federal level, the permission for this.
Oh, so the bills that I mentioned that are sort of on the wall federally are different proposals either to repeal or expand the federal deduction cap.
Okay. And right now it's set to sunset in 2025.
It's the end of
So the federal government would need to get it together to pass something in order to keep it alive.
to continue the cap, there would need to be further action federally.
And am I remembering right that historically, and I don't want you to opine on partisan politics, Abby, so please feel free not to answer, but historically, is this something that like was generally favored by sort of large Democratic majority states like New York and California, or is that a different?
The workaround or the deduction
The
cap?
deduction, the deduction itself, not the cap.
The deduction, I think that's, can reiterate what I've read and be happy to
Okay.
share. But for example, those bills that I just mentioned that would either repeal or expand the cap are all sort of northeastern, traditionally blue states. So states that tend to have a higher tax burden that are the most impacted by the cap. So yes, there is sort of a political line that's drawn around whether the cap should or should not apply.
Does this bill tie what we're doing to the existence of this permission at the federal level?
Yes, there's an effective date that has a contingency to whether or not it's extended or repealed federally. So it
So if it goes away at the federal level,
this also goes away. So if this were to be enacted as the effective dates are currently written, it would sunset whenever the federal credit whenever the federal cap sunsets.
But unless we do otherwise, when we do our annual link up, depending on which way Congress goes, we would either accept a new cap or not. Am I understand that correctly?
Yes.
Yeah. That's in, say, 26, after Congress has decided.
Sorry, no.
Oh,
So
okay.
the cap does not apply to determining Vermont tax liability.
Okay.
It only impacts it impacts taxpayers at the federal level. So by creating this workaround, we're not linking it in any way. there is no annual link issue here.
Because the AGI does not change
Correct, because this is on tax, the itemized deduction is on
independently of the
tax
link up.
income.
Okay,
So I'm doing this because AGI is up here, that's where Vermont starts.
right.
And the itemized deduction is coming out of taxable income, so whatever is happening federally, we're not linking to it. Vermont's acting sort of independently over here in this bill.
Okay.
Creating a workaround structure to help Vermont taxpayers who are part of a pass-through entity with their federal liability.
Got it.
That's a great question, sorry. I automatically said yes, but that is
Yeah, yeah.
not the case.
Thank you.
So the new credit on, so first there's the new credit on this pass-through entity tax. And then within an existing section of statute, which for resident Vermont taxpayers, there's a credit allowed for taxes paid to other states and provinces. And this typically applies when a taxpayer has tax liability in multiple jurisdictions, could be because they're moving or they have income from multiple states. It creates a new subsection within that section of statute, and it creates a non-refundable credit when there is a similar pass-through entity tax imposed in another state that individual member is liable for. It creates a credit in Vermont for 90% of the tax paid to another state. So it's a new non-refundable credit. It sort of mirrors the credit that Vermont's providing for its own pass-through entity tax in the sense that it's 90%. But it is for entity level taxes paid to other states.
Why would we do that?
So this is to prevent sort of double taxation where there's an entity operating in multiple states and it's being taxed on income earned in different states at the entity level to ensure that the individual member isn't being taxed twice on the same income.
Do we have to do that legally? Is it like actual double taxation that we have a legal requirement to, or is it like a metaphoric double taxation that we're doing because of?
So it would provide in the way that there's the existing credit for personal income tax when an individual has the way that different state tax law is written, there can be something called internal inconsistency. And there are different constitutional limits around this. And I did just read a really excellent article. I'd be happy to forward to the committee by Walter Hellerstein, where in this particular sort of legal analysis, not providing this type of credit would cause double taxation and there has been a fair amount of, this one's from 2021, but he cites lots of different cases that have both failed and succeeded depending on the state and their particular laws, claiming that these credits are not sufficient and do cause double taxation. So I'd be happy to come back with something more in depth, but it's sort of a tension around whether it is double taxation, whether it's not, and each state is treating it in a different way depending on their statute.
Okay, thanks. Yeah.
It would be nice not to be accused of double taxation. I mean, just have it straightforward.
Yeah.
A quick look-see at our immediate neighbors anyway, but whether they have included this non-refundable to avoid that problem would be useful.
Yep.
Like Mass in New York, if they're doing it, there must be a reason to stay out of court or however.
Massachusetts is one of the state, and Maine are some of the states that are noted here as having recent litigation on this, but they also have, it depends on the taxpayer as well.
He doesn't have a workaround though.
Maine, let's see, sure.
On your little map, that was one of the white states.
Yeah.
That might be the resident individual personal income tax credit. Not for the pass-through entity, but
It doesn't, according to your diagram.
yes, so this is for their personal income tax credit. They in particular, again, for the personal income tax, rejected the internal consistency claim. So I'd be happy to come back with a little more detail on other states and how they've treated this, but it's sort of a live question.
Thank you.
You're welcome. So the last two sections, section 4 creates the repeals of the workaround and then this credit for the taxes paid in other states. This is included because in the effective dates, as mentioned, it would repeal this structure either when it's currently set to expire federally, when the cap would go away at the end of 2025, or if that's extended whenever that takes effect federally. So that's where there would be a link. It's not the annual link, but there is a contingency. So federal action will cause this to, well, actually federal inaction will cause this to be repealed at the end of 2025. Federal action to extend it and having any sort of sunset will cause it to repeal at some yet to be determined date.
And this is more a question for Ted, but I don't want to forget to say it out loud when he's here. I imagine that I appreciate that there's sort of the contingent date and the repeal, but if we are making any revenue off of this and it is repealed, then we have all of a sudden a hole that we had not had before. So just want to sort of name that as part of the project that we're encountering here.
And it is a retroactive effective date, but it's the start of this year, so it wouldn't be available till next filing season, which is what you see with most income tax changes. Great, so I have some homework to do. I'll get back to you with more, a summary of how other states, maybe a map as well of which states allow for a credit for taxes paid to other states, and then some of the case law that's come out of these questions. This is all very recent.
And then as we think this through, I remember last year when we were talking about Social Security deductions, Graham created a flow, which is very confusing because of the deductions at the federal level and then the deductions at the state level. Graham created a flow chart for us that was really helpful. So that might be helpful for this long term. Thank you.
Cool.
Okay, I'm going to, for the record, Ted Burnett, Joint Fiscal Office. I'm going to work through more of the fiscal side of S45 and run through a few examples and also talk a little bit of the mechanics of what happens if you were to adjust potentially the PTE tax rate and also the credit. So that is the general, I'm not going to do that. Okay. First, we're going to start with review some key features, look at the distribution of pass-through income in Vermont and see who really would benefit from this legislation. Take a look at the state revenue impact and then also some considerations. So to start, review what a pass-through business is. There are, sorry, the bar in Zoom is in my way. In a pass-through business, profits get passed through to owners who pay on their personal income taxes. So there are three types of pass-through businesses. There are S corporations, partnerships, and sole proprietors. S corporations can have 1 to 100 shareholders. The S in S Corp stands for Small Business Corporation. They file a Schedule E on their 1040s. In a partnership, you have 2 or more individuals who own and operate a business. They have equal ownership rights. They also file a Schedule E. And then you have sole proprietors. They file a Schedule C. This tax type is not available to sole proprietors. Okay. I wanted to give you a few examples of the range of pass-through entity business types and how this could kind of flow through the economy. This really goes all the way from a handyman who owns spread income as a side business. These are sole proprietors. Again, this wouldn't influence, but it is a type of pass-through. You have small accounting firms with 3 partners. A local restaurant group with 10 equity investors would be a pass-through business, but it also includes a large multi-state financial firm with $10 billion in assets and 10 partners, for example, who, if they're not a C Corp, they could be a S Corp or a partnership. And so reviewing the features of S45, kind of putting together the section by section here, it would create a 7.6% entity level tax that is paid by certain types of pass-throughs. So this is happening at the pass-through level. It would create a refundable 90% personal income tax credit. As Abby mentioned, there's also a credit for pass-through entity taxes paid to other states, and reminding you that the tax is elective and must be elected by all members of the pass-through entity each year, and it would be effective for tax year 23. And so here's an example of how this tax would work with some numbers. I don't know, can you all read that? But it would start at the entity level. So we just gave an example of an entity here that has net income of $2 million. The entity overall has two partners. And so if they pay that 7.6%, their entity tax paid is $152,000. And each shareholder would be responsible for $76,000 of that entity tax paid. And then on each of those partners' personal income tax, their income before the PTE tax is deducted is $1 million, but because it came off the top, really their net income after the tax is deducted is $924,000. In this example, their filing status is married, filing jointly, they don't have any children, they have two exemptions. And so in that case, their income tax would have been $72,000.
Can I just clarify?
Yes.
So the person in the larger box is just one of those two partners.
Correct.
You're not
Yes.
saying that like the two partners are a married couple and then you're
No.
just a married couple.
That's right.
It's
Just one.
of the, and who knows who that other person is? We have forgotten about them entirely.
Yes, they're. Yes, to the extent we can, yes.
Thank you.
Yes. And so the state PTE tax credit, the 90%, would take $68,000 away from their state income taxes. And so it'd leave a remainder of $3,618 in this example. And so when you look at their total state liability, their total state taxes are almost $80,000 at $79,000, of which their state income tax portion is $3,618, and their state entity tax that they paid was $76,000, or the entity paid. So that's an example of how this would kind of work out.
What would their taxes be?
Yeah,
There was no.
What was
the
the
tax?
I can bring that, I have it in future examples. It's about $950 less.
So the 3,618 is $900 less than they would have paid to the state.
No, so their state personal income taxes would be about $78,000. These things kind of flow at different rates, in a way that's kind of tricky to explain.
We can wait and get
Yes.
more examples if that's helpful.
I think that makes sense. And if it doesn't make sense, then I can try and go back and clarify.
Super basic
Yeah.
question.
Yes.
Where did the 68.4 come from exactly? Like, that just seems like a number I can't swear. Where is that from?
It is if you
90%.
90% of $76,000.
Okay.
Yep.
Thank you. That's what I thought, but I took out my calculator and got something different, so, but it doesn't matter.
Oh, well, I will check into that.
No, it's not necessary.
And so after the example, I wanted to run through the distribution of pass-through income in the economy, and take a look at who is reporting pass-through income in the state of Vermont.
So this is who would be experiencing whatever this change we would be making.
Correct, exactly. And so looking at data from 2020, this is the most recent data we have available. Unfortunately, it is influenced by the pandemic. But there are a small number of returns overall in Vermont that report pass-through income. So only about 6% of total returns report pass-through income. And higher income individuals are much more likely to report pass-through income. So when you're at an AGI of $1 million or more, over 2/3 of those returns are reporting S Corp and partnership income.
And just so like, that is so wildly different from what the distribution of anything else in Vermont is, right? Like generally, whenever we're looking at anything else, there's like 2 people in that category and a bajillion people in the other category. And so this is quite a flip on like really any other distribution we look at.
And I also wanted to show that most pass-throughs are reporting a relatively low amount of net income. So the pie chart on the left is showing that over 80% of the S Corps and partnership returns are showing a net income of less than $50,000. But the amount of income on figure number 9, the pie chart on the right, 40% of the overall net income reported is coming from returns with over $50,000 in net income. So really just showing that a small number are reporting pretty large amounts of net income. And so to really kind of drive this home, who's impacted by the SALT cap, reminder, the SALT cap only allows up to $10,000 of paid state and local taxes unless you're married filing separately. And so the SALT cap really kicks in above $200,000 of AGI. 44% of resident returns reporting $150,000 to $200,000 of income would be impacted by the SALT cap, but it increases to 72% when you're between the incomes of $200,000 and $300,000 in AGI. And so that information also presented in a chart. It's helpful, as you can see, the number of income or the number of returns above $1 million who are impacted is 76%. And so from here, the JFO estimate of the federal tax benefits that would result from this pass-through entity structure, there's over $30 million in potential reductions in federal tax liabilities as a result of the pass-through entity tax, because folks are able to deduct it as a business expense from their federal taxes. And more than 70% of these tax savings would accrue to filers with an AGI of $500,000 or more. So really, these benefits are concentrated at higher ends of the income scale. And we are, from the maximum kind of reduction in federal tax liability, we're estimating that not everyone will take this up. So really the federal tax benefit will be about $10 to $20 million per year for resident filers. And also have this on a table. The red box is showing that most of the federal tax impact, which is the column where my cursor is now, almost half of the federal tax impact is going to, we estimate, will accrue to folks earning $1 million.
The way it was, I think, explained at one time, perhaps by Commissioner Bolio, there also was an advantage to out-of-state residents who had a business in Vermont and had Vermont income. And they would be advantaged if we went along and adopted a pass-through program that they could not take advantage of now, because of the home state, say, I'll pick New York, which would only allow liability in Vermont to be counted if Vermont adopted this approach, the workaround. Am I remembering that correctly?
I do not remember Commissioner Bolio's testimony.
Okay.
So I could definitely check in and dig in and
I just
give an answer. Yeah,
because you were calibrating the benefit both at the federal level, which would be independent of which state someone filed in, but then it seemed to me there was an additional benefit to, say, New York filers if we adopted the workaround.
Yes, and these calculations are only for Vermont
Yeah,
regulated filers.
I understand that. Just wanted to get the full flavor of a benefit.
Sure. Yes, and I can definitely follow up with the committee to how this might benefit other folks as well.
Thanks. I'll wait for the follow-up.
Right. And so now to move on to the state revenue impact. The amount of potential state revenues from this really depend on the design of the tax and credit. As proposed in S45, we're anticipating a positive revenue impact, however small. I'll get to that in later slides. The mechanics of this are, it's helpful to think of the 90% credit as a 10% tax because the state of Vermont is withholding 10% of the pass-through entity tax paid. Since that is higher than the highest marginal personal tax rate of 8.75, it's going to generate really small kind of additional revenues for each pass-through entity tax. That pass-through entity that elects to take the tax. And so we're kind of concurring with the estimate that it would generate $500,000 per year in additional general fund revenue. With the caveats that limited data are available, and this would depend on take-up, and take-up ultimately depends on each individual filer's kind of tax benefits and costs in this. We, went and checked because there are limited data. We looked at other states, and other states really didn't put a revenue estimate or forecast minimal changes as a result. And also want to note on this is that it's available under 3 years. It is scheduled to sunset at the end of 2025.
What happens if it's 15%?
So with the pass-through entity tax rate, it really depends on the credit. The credit kind of absorbs, so you could charge people more in taxes, but then they'll just get it back on their personal income tax returns as a credit.
I think, are you wondering if you made it at 9.85%?
I'm going to get into some examples on that.
Great.
Yes. And so wanted to talk generally about the impacts of tax rate changes. So if you increase the PTE tax rate, it's going to decrease folks' federal liability because they're able to deduct that as a business expense. And it increases both the tax and credit in Vermont. And with a decrease in tax rate, kind of the inverse is true. Generally, when I looked at this for a few examples of different taxpayers, the federal liability changes more than Vermont liability just because that credit is really absorbing a lot of the increase. So if you increase the PTE tax rate, folks are going to get more in credit. And so the state doesn't really gain as much by changing the rate.
Can you explain that again?
So in the example that I presented.
An example.
Yes, let me try and. So in this slide, with the PTE tax, when you increase the rate, they would pay more in state entity taxes, but they would also get a higher credit. So their state income tax paid would go down. So you're getting more in state entity tax, but you're getting less in personal income tax. And so those kind of work against each other, at least at the tax rate. And so the impacts of the changes in the tax credit, if you increase the tax credit, it doesn't change the federal tax liability, but it does decrease your Vermont liability because you're getting more of a refund on your personal income taxes. If you decrease the tax credit, then you do increase taxpayers' Vermont liability. And I'll run through two examples of it.
That was what my question was
Yes.
the increase of the PTA tax credit.
Sure. Yeah.
So nationwide, this could be quite a hit to the federal tax.
Sure could.
So have they approved this, or are they questioning it, or any lawsuits, or what's the deal?
The IRS, from what Abby went over this in her presentation, that the IRS issued a notice which effectively gave their blessing to these types of workarounds. And so as far as I understand it as it is now, this is something that can work under federal tax law.
But broadly, we're having, huge national conversations about, tax evasion, legal tax evasion across the entire globe. And last year, the House both the Commerce Committee and the Ways and Means Committee said, no, we're not, even if this might be sort of more advantageous for Vermonters, we're not interested in contributing to tax problems at the federal level, even if it's legal. And the Chairman Marcotte had a very nice quote in Digger about it, about just sort of the wealth gap and not wanting to contribute to it.
So it died last year.
It did.
Some of those people are still here.
Many of those people are still here.
So we're doing it anyway?
We're just discussing it because people want us to talk about it.
Okay, all right.
And we talk about things that people want us to talk about it. Many of those people are still here and are very uncomfortable about it.
Okay.
But we're going to talk about it because people want us to talk about it. And the Senate sent us a bill and it's our responsibility to talk about it.
I appreciate that.
Yes,
Thank you.
yes.
And this is not a question for you necessarily, but I recall there was the claim that this might incentivize someone to branch out who already has a business in New York, who might consider extending that business to Vermont, if and only if we did that. Precisely because they would face multiple regimes in the states in which they derive income. That's an economic development argument, not a fiscal argument. I need to have clarity whether that's really so, for whomever, if you will, could advise.
Why don't we save that question
Yeah.
for when we have other witnesses?
Absolutely.
Unless you want to comment on the,
I either want to cross it off my list as a consideration or say it may be real.
Yes, I would have to do definitely more looking into cross-border implications of this for sure. And I could definitely do some of that work and come back with some answers.
yeah.
You don't happen to know what the vote in Senate Finance was on this?
I would have to pull up the vote. Sorry.
I think Abby does.
You know the no?
Okay.
I don't know.
Okay, all right.
So now for the promised examples. With a 90% credit, this is part of the math that we worked through before, but this also includes a comparison with current law. So under current law, a taxpayer with $1 million in pass-through income would pay $78,000 in state income tax. They wouldn't pay an entity tax because it doesn't exist. And their federal income tax liability with that income would be $219,000 and $219,000. With the ability to deduct state entity tax paid, their federal liability would decrease to almost $197,000. Their state taxes would increase by $950. And this is because of the kind of mechanics and the interplay between the state income tax and the entity tax with the example we worked through before. So in total, their total tax difference is they're gaining a decreased liability in federal taxes, paying a little bit more to the state for pretty sizable tax savings. And that kind of motivates the construction of this tax type. With a credit of 87.5%, I chose this because it is the credit that's offered by Connecticut, and it's as far as I know, the lowest credit amongst the states who enacted this. The state taxes increase a little bit. They increase a little bit relatively speaking, but it's 3 times higher. The difference is almost $3,000 in state taxes paid, but the federal tax liability isn't any different between the two constructs.
So I think you were able to estimate that this would generate, as the bill currently imagines, about $500,000 per year in additional general fund revenue. Are you able, and I guess, right, you estimated that the loss at the federal level would be between 10 and 20 million.
Mm-hmm.
I'm curious, like, what percent of the federal tax revenue? That sounds like a lot, but also
It's a drop in the bucket.
around what Vermont sends annually to the federal government?
Yes, I would have to, it is a very small amount, but I could come back with the exact amount.
And then you modeled what this looked like across the state at the 90 have you modeled across the state at the 87.5 the way you did in this example?
Yeah, so this is really tricky to do. So this is just an example at this point. To model different credits, we have to go into like the Chainbridge income tax model and do some work in there. And we haven't done that yet, partially because the expert in Chainbridge, Graham, is no longer with us. So yes, but this implies basically that there's a kind of 3 times higher revenue generation to the state by going with an 87.5% credit. I think the challenge here is that as you start decreasing the credit, it increases effective tax paid by folks, and you start getting into double taxation arguments. And then you're also finally you're treating folks more like C corporations than pass-throughs, and because C corporations, right, are paying on dividends that get passed through. So just a few considerations here. It's very hard to estimate, and it ultimately depends on who takes this up.
Yeah.
Is, in this example, what rate did you use for the taxation at the entity level? In the proposal, ours is the second highest, which is 8.7 or something. What did you use in what does Connecticut use and you used in this example?
I only used the credit percentage from Connecticut, so it's 7.6% in this example.
So the rest you kept the proposed figures?
That is
got it. Okay, thank you.
And then, because JFO loves considerations, there are a few considerations with this tax type. First of all, it treats different classes of income differently. Wanted to flag, the legislature's goals of vertical equity in income taxes. Does that extend beyond the Vermont tax code to the federal code? It's a discussion around what the chair was mentioning earlier around, is it okay to kind of look to the federal code and make decisions in the Vermont tax code as a result. And then it introduces a third business type option into the tax code. So this is a simplicity consideration going back to the 6 pillars introductions that were done at the beginning of the session. So first of all, a PTE tax treats different classes of income differently. So it's only available, the PTE taxes, to S corporation or partnership income. That's only 6% of returns. Taxpayers who earn income exclusively through wages and Social Security, this does not apply to them. Also, sole proprietors are a type of pass-through entity, but could not access the pass-through entity tax under current law. Second, wanted to ask the questions of how important is the progressivity of the overall tax code, because this tax type would make overall tax burdens of Vermonters less progressive. And it's also applying to folks at the highest income levels. So remember from earlier that 70% of the federal tax benefits would accrue to a small number of filers. These are folks earning more than $500,000 in AGI. But this would not really change the distributional effects of the tax code at the state level because those changes are just so small. Also wanted to mention that in Act 11, 2018, Vermont did a lot of work to decouple from federal tax code and created new Vermont standard deductions and personal exemptions, and mentioned that this policy is set to expire after 3 years. So as the chair mentioned, this could generate revenue for 3 years, but that would sunset along with the federal policy. And then finally, this injects a little extra complexity into the tax system. So remember from the 6 pillars, one of them is simplicity. Simplicity maintains that revenue systems should be easy to understand, minimize compliance costs, and be as simple as possible to administer. The point that there's folks have made the point that non-resident pass-throughs can pay at the entity level, but this is done to reduce complexity for them and the tax department. This isn't necessarily, from what I understand, a decision because of any particular benefits. So businesses can currently pay on corporate income taxes, on their personal income taxes, and the pass-through entity tax would just add another tax option. This tax would also require additional compliance costs, and the compliance costs would be unequally distributed. Wanted to ask if this workaround is accessible or easy to any business or individual who does their own taxes. And then also finally, around the simplicity argument, it could introduce distortionary incentives around business structure decisions. So if you are a sole proprietor, you might find a way to incorporate as a partnership just to take advantage of the tax. So that's it. I also wanted to, Graham wrote a fantastic issue brief on pass-through entity taxes and salt cap workarounds. Some of the data from this presentation came from there. It's a really good kind of longer view picture of the overall universe of pass-throughs and how the PT tax might influence those folks.
Marsha, can you post that and send it to us? Thank you.
That'd be good.
Same year.
Yes.
Yeah.
I'm not sure whether it was Graham or perhaps during the summer task force study on income-based property taxing, but I remember a graph of the effective tax rates across income categories. And I also remember at the far upper end of the distribution of income for Vermont, the effective tax rate reached a plateau and then took a little nosedive. And I'm curious whether or not your choice, or I should say the Senate's choice, of using the second highest rate as opposed to the highest rate would change your narrative any in your last two statement slides about progressivity or distribution of wealth. You made some comments in that narrative, the first two, before you got to simplicity. And I'm wondering if those narratives would change if in a counter proposal, we use the highest rate, not the second highest rate.
Yes, I will say those points around progressivity apply kind of to the whole tax burden of taxpayers. So looking at the federal level, since folks are getting savings on their taxes, it would make kind of the overall tax burden on Vermonters less progressive. To your question about changing the rate, I would say that it is getting absorbed a lot by the credit. So I don't know how much that would change it, but what I could do is run a few examples with the higher tax rate and present those to the committee.
We agree that the graph
like.
does have
Yes.
that pattern to it, and it's sort of eccentric in a way. It's counterintuitive, I guess.
Yes, if I remember correctly, yes.
And I imagine to be able to complete this conversation, we're going to need to look at the overall tax responsibility of Vermonters, and then who pays which different kinds of taxes, I think is an important part of this. We also did some really amazing corporate reform work, and we're seeing some early and sort of wild returns on that. And so it'd be helpful for us to check back in on our corporate tax structure and just sort of remind ourselves about that in the context of, we didn't change any rates when we did that, we just changed the structure. And so it might be helpful for us to explore that as part of this conversation as well.
Just wanted to go on the record as saying, I called you out potentially as making a math error earlier in this presentation, and I've since learned that I in fact made that math error. I just wanted to besmirch your name.
I appreciate that. It is always nerve-wracking when I'm like, oh my gosh, have I messed up in Excel? But I appreciate it.
It was fine.
Thank you.
Okay. Thank you very much. Really
Thank you.
appreciate it.
Yes.
Thank you, Ted.
We're going to take a 15-minute break and we will be back to talk about finding